Okay. So just a quick note. I'm doing this live from the headquarters of Soriano Motor. In brief, what we're going to talk about is data, projections, and opinions. That as of this date, on what I'm saying, they're going to be probably subject to change. But it's going to have an overall view of what's happening with the U.S. economy. 4 points. Number one, and this is in brief. The US economy shows early signs of re-accelerating. Consumers remain healthy, corporate profits turning higher, and monetary policy is pivoting from tightening to easing. Two, we continue to favor both stocks and bonds overall. This month, we made tactical adjustments designed to increase our exposure to areas that are more correlated with easier financial conditions in the coming year by raising, for example, our allocation to US small caps and some cyclical sectors, and not due to a change to our positive view on higher quality bonds. Number three, January, February, as we're wrapping up February, we're upgrading small cap equities on a very attractive valuation, lower interest rates and cost of capital, improving technical trends, and a potential earnings inflection later in 2024, which is expected. And point four, while we're still favorable on significant allocations to bonds in diversified portfolios, this month we used fixed income as a source of funds to reposition favorably within equities. So we accomplished this with a move to slight underweight on municipals, and they have become expensive again, in our opinion. I don't know what you're thinking. So keep in mind the two things from two perspectives, right? Once the Fed cuts, the investor focus will likely shift to why are they cutting? Is it to normalize yields? Is it to normalize the yields, or is it because growth worries are accelerating? Another question would be what will the frequency of the cuts be? Another one will be quarterly or more frequent. Does this accelerate another expansion or help the normalization process, right? From a portfolio strategy consideration, one, remain fully invested. Two, use cash to support new positions in equities and bonds if under your benchmark. Three, stay diversified with a light increase to equities. Four, be ready for opportunities to broaden your exposure slightly to small cap shares. Five, use weak periods as an opportunity to rebalance and reposition. Six, while recognizing favorable valuations in some developed emerging markets, our asset allocation bias remains titled towards US assets. Now, given all of these that have made for the following tactical asset allocation adjustment for February, we're going to be, for example, we raised equities to slight overweight from neutral. We funded the increase in equities from exposure to areas of richness in fixed income. We also increased the small capitalization shares to slight overweight from neutral with a tilt toward value in this asset class. And lastly, increase our exposure to cyclical equity sectors. This is where we're at. Hope this helps. If you have any questions, you know where to reach me. Thank you. Thank you for tuning in as always.